On March 8, 2023, Silicon Valley Bank was the 16th largest commercial bank in the United States, managing over $213 billion in assets and banking half of all venture-backed tech startups in America. 36 hours later, the bank was completely extinct. In the fastest bank run in human history, panicked tech founders and venture capitalists pulled $42 billion out of SVB in a single day. Venture capitalists sent frantic Slack messages, WhatsApp texts, and viral tweets instructing their portfolio companies to wire their cash out immediately. By Friday morning, March 10th, regulators shut down the bank, seizing control of SVB in the second-largest bank failure in American history. This is the story of Silicon Valley Bank, how a 4-decade financial bedrock of tech innovation was brought down by interest rate blunders, hyper-connected social media panic, and a 36-hour digital stampede. Silicon Valley Bank was founded in 1983 over a poker game in Santa Clara, California, with a simple mission: bank high-risk tech startups that traditional banks turned away. As the tech sector boomed, SVB became the golden goose of Silicon Valley. During the 2020 and 2021 pandemic tech boom, startup funding exploded. Tech companies flooded SVB with cash, driving total bank deposits from $60 billion to a staggering $189 billion in less than 2 years. SVB executive leadership faced a massive problem. They had way too much cash and not enough tech loans to issue. So, management invested over $80 billion of customer deposits into long-term U.S. Treasury bonds and mortgage-backed securities, earning a modest 2% yield. They assumed interest rates would stay near zero forever. It was a fatal miscalculation. In 2022, inflation surged, forcing the Federal Reserve to launch the most aggressive interest rate hikes in 40 years. As interest rates climbed from 0 to over 5%, the market value of SVB's low-interest bonds plummeted. Meanwhile, startup funding dried up, and tech companies began withdrawing their cash from SVB to pay employee salaries. To meet these cash withdrawals, SVB was forced to sell $21 billion of its bond portfolio at a devastating $1.8 billion loss. On Wednesday afternoon, March 8, 2023, SVB publicly announced the loss and stated it was trying to raise $2.25 billion in emergency capital to plug the hole. Executive leadership intended to reassure Wall Street. Instead, the announcement sparked instant terror across Silicon Valley. Unlike traditional 1930s bank runs where lines formed down the street, SVB suffered the world's first smartphone bank run. Top venture capital firms like Founders Fund, Coatue, and Union Square Ventures told their founders to pull their money immediately. WhatsApp groups exploded with panic. Prominent VCs posted warning tweets that were viewed millions of times. Founders logged on to SVB's online banking portal simultaneously, clicking transfer on hundreds of millions of dollars. On Thursday, March 9th, customers attempted to withdraw $42 billion, roughly $1 million every second. SVB's wire systems collapsed under the strain. By Friday morning, the bank was illiquid, and the FDIC stormed the headquarters, halting all operations. SVB survived 40 years of economic cycles, only to be destroyed by a textbook mismatch between long-term assets and short-term liabilities, accelerated by the speed of the internet. To prevent global contagion, the Federal Reserve and FDIC declared a systemic risk exception, guaranteeing 100% of all customer deposits. $213 billion in assets, $42 billion pulled in 24 hours, 36 hours to